Students, in this video we will see the meaning and concept of cash flow statement, okay? Objectives, importance, its limitations, and how to prepare cash flow statement, okay? So let us start. So before we begin with the cash flow statement, let us go back to class 11 and try to understand the golden rule for real account, okay? So in class 11 we have already discussed that the golden rule for a real account is debit what comes in, credit what goes out. So whenever the real account, you already know that cash is also a real account. Okay, so whenever the cash comes in, okay, it was debited. Okay, it is to be debited. Sorry, and whenever the cash goes out, it is to be credited. Okay, so the cash book or cash account, it shows the movement of cash in and out, isn't it? So whenever you receive the amount of money, it will be in. Okay, it is treated as the cash in. Okay, so that is your debit. Okay, so whenever you make the payment to someone else, okay, so that is your cash out. Okay, which is to be credited. Similarly, cash flow statement also shows the movement of cash flow. Okay, and there are two types of flows, which is in one is inflow and the other one is outflow. Okay, so what do you mean by inflow? So whenever the cash comes in, okay, that is your inflow. Okay, whenever the cash comes in, that is your inflow. Okay, and whenever the cash goes out, that is your outflow. So there are various sources from where you can get the cash in. Okay, for example, dividend received. Okay, sale proceeds from uh, assets. Okay, the fixed assets like machinery. Okay, plants, furnitures, fixtures, land and building. Okay, etc. And whenever you receive the money from debtors, okay, and when you make the sales, okay, that is also your source of inflow of the cash. Okay, and now whenever you make payment to the workers, okay, you pay the salaries to the managers. Okay, you purchase raw materials, you make the payment for advertisement, that is your outflow. Okay, or you purchase some new plant and machinery. Okay, you purchase a piece of land. Okay, and you make the investment in some company, that is your cash out. Okay, so uh, as we can see here that this cash flow statement is a statement. Okay, cash flow statement is a statement, it is not an account. Okay, but whereas this cash account or cash book is itself an account. Okay, because here debit and credit is used. Okay, but in the case of cash flow statement we do not use the concept of debit and credit, but we will stick to this concept, that is what comes in and what goes out. Okay, so cash flow statement is a statement that shows the movement of cash, okay, or the flow of cash, okay, that is inflow and outflow of cash and cash equivalents. Okay, so what do you mean by cash and cash equivalents? By cash we mean the liquid money, okay, that is the cash in hand. Okay, and the cash equivalents include bank balance, okay, marketable securities, okay, or the current investments. Okay, that is your cash and cash equivalents, okay, combined together. Now you can see here that this uh, current investments, okay, unless specified otherwise, current investments are to be considered as marketable securities. Okay, and hence it will be treated as cash and cash equivalents. Okay, we will see how it will be treated when we do the numerical questions. Okay, now you can see here some examples of cash flows. Okay, so this is your cash inflows and these are your cash outflows. Okay, so just go through this. PDF has been already sent to you. Okay, so just go through that. Okay, so there are two methods to prepare cash flow statement. Okay, that is direct method and the other one is indirect method. Okay, this direct method is not in our syllabus, so we will not discuss about it. Okay, so we will prepare cash flow statement as per indirect method. Okay, and this direct method and indirect method is prescribed in accounting standard 3. Okay, so as per AS3 we will prepare cash flow statement. Okay, and the cash flow will be classified under three main heads, that is, number one, cash flow from operating activities, number two, cash flow from investing activities, and number three, cash flow from financing activities. Okay, because of an organization or an enterprise, the activities are classified into three categories. Okay, number one is operating activities, number two is investing activities, and number three is financing activities. Okay, we will discuss this after some time. Okay, so cash flow statement by indirect method is prepared on the basis of financial statements, that is balance sheet and statement of profit and loss. So in our textbook, only the balance sheet has been prepared from balance sheet. Okay, but I cannot see the questions from this statement of profit and loss, so we will be doing extra questions also. Okay, now what are the objectives of cash flow statement? Okay, number one, to determine the sources or the receipts of cash and cash equivalents. So one of the main objective of cash flow statement is to locate the sources of cash and cash equivalents, just to know that from where the cash is coming in. Okay, and to determine applications or the payments of cash and cash equivalents, to know where the money is going out. Okay, and ultimately to determine the net effect or the net change in cash and cash equivalents. So after knowing the sources and the applications of cash and cash equivalents, we come to know the net effect. Okay, we do the adjustment of both receipts and payments. Okay, if the cash is decreasing, okay, or the cash is increasing, so that is your net effect or net change in cash and cash equivalents. Okay, now the importance of cash flow statement. uh, the importance of cash flow statement are seven. Okay, I have discussed here only 7 points. Okay, there can be many more other importance also, so let us discuss them in brief. Number one, short term planning. So why we prepare cash flow statement? Okay, so what happens after the preparation of cash flow statement? What does it do? Okay, so it helps in the managerial perspective. Okay, so from the managerial perspective we can say that the cash flow statement, it helps in the making of short term planning. Okay, uh, uh, this short term planning can be treated as the planning for a specified period. Okay, so just like this coronavirus situation. Okay, so in this lockdown, okay, where the entire global economy is under recession. Okay, slowly and gradually we are now coming out of it. Okay, we are in the stage of recovery still. So this cash flow statement will help us how to do the planning for a specific period of time or a short period of time. Okay, so how to control the cash if the cash flow, I mean the outflow is more. Okay, so how to control that outflow. Okay, and how to maximize the inflow of cash will be your short term planning. Okay, now helps in assessing liquidity and solvency. So after having the clear picture of cash flow statement, okay, the money, I mean the inflow or outflow from operating activities, from investing activities and financing activities, we will be able to assess the liquidity and solvency of a particular firm. Okay, now efficient cash management. Okay, so now the main reason behind the preparation of cash flow statement is cash management. Okay, so if in an organization, if the cash is going out for no reason, okay, if the cash is just going out and there is no inflow, for example, Okay, so that particular business is not performing well. Okay, so the cash management is very much important at that point of time. So the cash flow statement, it gives information relating to surplus or deficit of cash, okay, in any of three activities that was discussed before, that is operating, investing, or financing activities. Okay, whether there is surplus in operating activities or deficit in operating activities. If there is deficit, how it can be now converted into surplus. Okay, so that will be discussed in efficient cash management. Now, comparative study. Uh, Comparison of the actual cash flows with the budgeted cash flow of the year shows the extent to which cash and cash equivalents were generated or sourced and applied or used as per the plan. So whenever we prepare a budget, okay, budget is actually an estimation. Okay, so while preparing a budget for a particular year, we estimate a certain amount of money, okay, or the cash. And while preparing cash flow at the end of the reporting period or at the end of the financial year, we can compare, okay, we can compare with the budgeted cash flow with the real or the actual cash flow that has been shown through cash flow statement. Okay, so that then we can compare, okay, whether there was deficit or surplus. Now, the next is reasons for cash position. Now, what does it mean? Okay, so cash flow statement shows the reasons for lower and higher cash balances with the enterprises. How does it do? Sometimes an enterprise has lower cash balance in spite of higher profits or has higher cash balance in spite of lower profits. So through the preparation of cash flow statement, we can come to know it. Okay, what is the uh, cash position and why this cash position? That is the reason for your cash position, because sometimes it has been observed that the enterprises or the companies which has lower amount of profit, okay, but still they possess higher amount of cash, okay, high volume of cash. So how is this possible? Okay, and if a firm is having higher amount of profit but less amount of cash, so what is the reason behind this? Okay, so we will come to know. Now evaluate management decisions. So cash flow statement, by providing information relating to companies investing and financing activities, it gives shareholders, okay, uh, potential investors or creditors the information about cash flows, which helps them evaluate management decisions. Okay, now the last one is dividend decision. Now dividend payable is deposited in a separate bank account. We already know that. Okay, so this is actually called interim dividend when it is declared. Okay, so now when it was now sorry when it is now approved, it is called final dividend. Okay, so this cash flow statement, it helps in deciding how much dividend should be paid. Okay, because the cash flow statement, it shows the position and the flow of the cash. Okay, so if there is higher amount of cash flow, okay, that is the inflow. Okay, if there is more inflow and less outflow, then we can know that we can pay more amount of dividend. Okay, and if there is deficit in cash flow statement, okay, which means more outflow and less inflow, then we will pay less amount of dividend. Okay, so these are the importance of cash flow statement. Now, limitations of cash flow statement. Now, what are the limitations of cash flow statement or the drawbacks of cash flow statement? Number one, non-cash transactions are not shown. So the transactions which are non-cash are not shown in cash flow statement. Okay. For example, it does not show non-cash transactions like purchase of building by issue of shares or debentures. okay, like the purchase consideration, which we have already seen in previous chapters, that is issue of shares and issue of debentures, okay. So when you issue number of shares or debentures for the purchase, sorry, against the purchase of any fixed asset, okay, that transaction is not shown in the books of, in the cash flow statement, okay. And a cash flow statement is not a substitute for an income statement. Now, what do you mean by income statement? By income statement, we mean profit and loss account, okay, or statement of profit and loss, okay. So, which shows us the gross profit as well as net profit, okay, combining both trading account and profit and loss account, okay. So, income statement, it actually is prepared on the basis of accrual basis, okay, and cash flow statement is prepared on the basis of cash basis, okay. So we can say that cash flow statement is not a substitute for income statement, okay, because while preparing income statement we combine all the other accrued expenses, outstanding expenses and accrued incomes, okay, for that particular specific period, okay. But the cash flow statement, it shows the actual flow or the movement of cash, whether it is inflow or outflow, irrespective of financial year. It is not a substitute for balance sheet. Of course, it is not, because uh, balance sheet cannot be substituted by cash flow statement. Why? Because balance sheet, it gives us the complete and the comprehensive picture of the position of assets and liabilities, whereas cash flow statement, it only shows the position of cash in the business. Okay, it only shows where the money is going out and why the money is going out. Okay, in three different activities, okay. But balance sheet, it shows us the financial position of a particular company, okay. Now number 4 is historical in nature. So what does it mean? It actually rearranges available information in the income statement or balance sheet, so therefore it is historical in nature, because cash flow statement is based on, okay, this cash flow statement is actually prepared after the preparation of balance sheet and income statement, okay. So the values that have been already calculated or that has been already shown in the balance sheet or are already appearing in the income statement uh, provides information or provide ground for the preparation of cash flow statement. So whatever the figures that have been used, okay, these are previous balances, right? So thus they are historical in nature. Assessment of liquidity. Now the liquidity of the enterprise cannot be determined from cash flow statement alone, because it depends on other factors. Sorry for that. Okay. Other factors like current assets and current liabilities, okay, and cash equivalents is one of the components of current assets, okay. Let me explain this point one more time. Assessment of liquidity, okay. So the liquidity of the enterprise cannot be determined from cash flow statement alone, because it depends on other factors like current assets and current liabilities. Cash and cash equivalents is one of the components of current assets. Okay, now accuracy of cash flow statement. It is prepared from the financial statements. So if financial statements are prepared incorrectly, cash flow statement will also be incorrect. Okay, so these are the limitations of cash flow statement. Now, three activities that has been already discussed, okay, in brief before. Now let us discuss them in detail, but not too much. Okay, so now operating activities, investing activities, and financing activities. So what do you mean by operating activities? So by operating activities, we mean the principal activities, okay, of a business firm, okay, which are not investing or financing activities. For example, cash sales, receipts from debtors, wage payment, payment of tax, etc. These are called operating activities. By operating activities, we mean the primary activities of a business organization. Okay, for example, if you have a shop of, say, clothes, okay, garments, okay, what is your primary activity? Your primary activity is to sell and purchase clothes, garments, right? So this is called your operating activity. Now let us say there is a bank, okay. What is the primary activity of bank? The primary activity of bank is to accept deposits from public and provide them loan, isn't it? So this is the operating activity of a bank. Now this operating activity, it varies from one business to the other business. Okay, how it is possible? Because it depends upon the nature of the business. Okay, what type of business you are doing. Okay, if you are involved in the trading business, okay, in terms of goods and services, then purchase and sale of those goods and services is your primary activity, that is operating activity. Okay, now investing activities. By investing activities, we simply mean purchase and sale of long term assets, that's it. Okay, or the fixed assets. So whatever be the nature of your business, you purchase fixed assets, okay, and other investments. These are called investing activities. Okay, now financing activities. What do you mean by financing activities? So financing activities are the activities which result in change in size and composition of owner's capital, okay, including preference share capital in case of a particular company. Okay, so it actually shows the position of finance in the business. Okay, so from where the money is coming in, okay, and it is adding to the size of your capital, okay, and from and to where the money is going out, which is decreasing the amount of capital, okay, from the enterprise. So these are your proceeds from issue of shares, okay, or this increase or decrease in bank overdraft, okay, dividend paid, etc. Okay, so as I've already explained before, that the nature of business determine the activities of an enterprise. Okay, as you can see here in this picture also, I mean this diagram, proceeds from issue of shares can be financing activity for one company, and it can be operating activity for the other one. Okay, so for non-financing company, it will be a financing activity, but for financing company, it will be operating activity. Okay, so by non-financing company, we mean those companies which do not involve in the acceptance and the lending of money. Okay, these are called non-financing company. For example, uh, Big Bazaar, okay, Spencer's, okay, Reliance Trends, okay, or the showroom of uh, clothes, okay, shoes, restaurants, okay. These are non-financing companies, okay. But the financing companies, they involve like Max Life Insurance, okay, Bajaj Insurance, okay, Bajaj Finance, okay, uh, and other brokerage firms, okay, which deals in the purchase and sale of shares, debentures, okay, stocks. These are called financing companies, okay. So for a financing company, this uh, issue of shares or the purchase of shares is treated as operating activity, but for non-financing company, proceeds from issue of shares or the sale of issue of sorry, or the sale of shares is treated as financing activity. Okay. Now the types of activities we have already discussed, that is operating activity, investing, and financing activities. Okay. Now the steps involved in calculation of cash flow from operating activities. Now how to calculate cash flow from operating activities, because this cash flow from operating activities is quite tricky. It's quite difficult one, because the calculation of cash flow from investing and financing activities are very simple. Okay, I have shown here step 1 and step 2. There is no such hard and fast rule that this is step 1 and this is step 2. Okay, it can be step 1 and can be step 2. It is just for your reference. Okay, but in the calculation of cash flow statement, sorry, this cash flow from operating activities, you have to follow these steps. Okay, in series. Number 1, step 1, calculate net profit before tax. Okay, I'll show you how to calculate this net profit before tax. Okay, and in step 2, you will write adjustment for non-cash and non-operating activities. Okay, and in step 3, you will write operating profit before working capital changes. Okay, that is your step number 3. And step number 4 will be adjustment for change in working capital. And step number 5 will be cash generated from operating activities. And step number 6, that is adjustment for tax. Okay, the tax paid will be subtracted. Okay, and finally, cash flow from operating activities, that is your last step. Okay, that is step number 7. Okay, but if there is no tax paid or no information about the tax is given in the question, then at step number 5, we will get cash flow from operating activities. So at that point of time, this step 6 and 7 will be removed. Okay, and in step 5, we will get our answer, that is cash flow from operating activities. Okay, be it negative or positive. Okay, so we already know that in investing activities, it actually involves the purchase and sale of fixed assets. Okay, so when we purchase fixed assets, it is called outflow, because the cash is going out, isn't it? So when we sell fixed assets, cash comes in. That is the inflow of cash. Okay, and this cash flow from financing activities. Now, when you issue shares and debentures, it is called inflow. Okay, and when there is increase in bank overdraft, that is also called inflow. Okay, if your bank overdraft is increasing, that is your inflow actually. So what do you mean by bank overdraft? By bank overdraft, we mean the negative bank balance, right? Okay, just assume it to be. Okay, so this negative balance is increasing, which means you are using money from the bank. Okay, in extra, you are taking credit, in fact. Okay, so your credit amount from the bank is increasing, which means you have no money, but you are utilizing money, you are using money from the bank. Okay, so which actually is treated as inflow in the business. Okay, and when you make payment to the shareholders in the form of dividend, okay, it is your outflow. Okay, when you pay dividend to shareholders, it is your outflow, because the cash goes out. And when you redeem the number of uh, shares and debentures, I mean the preference shares or equity shares, oh sorry, when you redeem preference shares or debentures, it is called outflow, because the money, it goes out. Okay, and when the bank overdraft is decreased, it is also called outflow. Okay, so you must have noticed something that for example, if you have a negative bank balance, okay, let us say minus 10, let us just suppose that. Okay, and if you deposit 100 rupees into your account, what happens is that the bank will deduct that negative balance, and the remaining 90 rupees will be in your bank, isn't it? So minus 10 will be adjusted before. Okay, so you had deposited 100 rupees, but 10 rupees is deducted from the bank, isn't it? So this 10 rupees is going out of your bank, isn't it? So that is why it is also treated as outflow. Okay, now the calculation of net profit before tax. Okay, so this is very simple, in fact. So you will be provided with a balance sheet. Okay, so from the balance sheet we can see that whether it is profit or loss. Okay, the closing balance will always be on top. Okay, and we will subtract the opening balance. Okay, so whatever is the difference here, it will be the profit for that particular period. Okay, now in which dividend paid will be added. Okay, tax paid or provision for tax will be added. Okay, and transfer to general reserve or simply reserve will also be added here. Okay, and ultimately we will have the net profit before tax. Now you may ask me why the dividend paid or the tax paid or the transfer to general reserve is added back here. Because dividend is a part of profit, right? So dividend being a part of profit should be added to it. Okay, and as the name it says, that is NPBT, that is net profit before tax, so the tax should be added before we are because we are calculating the net amount of profit before paying the tax, so the tax should be added back. Okay, and before we transfer the amount of money to general reserve, okay, it should be added here, because reserve is an amount of profit set aside for future purpose. Okay, so whenever you transfer any amount of money to reserve or general reserve, it should be added back to calculate net profit before tax. Okay, now the question, why adjustment for non-cash and non-operating items or activities? Why do we have to do that? Why? Because in this step number 2 here, okay, there is the adjustment for non-cash and non-operating activities. So why are we doing this? Okay, because when we calculate net amount of profit, okay, some non-cash uh, transactions like depreciation, okay, it will be subtracted from the net profit, and again the amortization of goodwill or the goodwill written off is also subtracted. Okay, but in fact these are non-cash transactions. Okay, because whenever we calculate the amount of depreciation, okay, whenever we subtract it from the net profit, uh, in actual the cash is not decreasing, only the amount of profit is decreasing. Okay, so there is a controversy also here. So many accountants, they believe that this way um, depreciation can create a secret profit or the secret reserve also. So that's a matter of debate. Let's not go into it. But whenever we calculate this depreciation and is subtracted from the net profit, actually the cash is not disturbed. Okay, so hence it should be added to it. Okay, and this depreciation is also treated as phantom expense. Okay, because it is only shown in the books. In the actual or the practical life, depreciation, it doesn't exist. Okay, because it doesn't affect the position of cash, in fact. Okay, and if you receive any dividend, okay, or if you receive uh, anything that is not related to the primary activity, okay, then it is treated as non-operating activities or items. So ultimately we can say that both non-cash and non-operating items should be added to or should be adjusted while calculating cash flow from operating activities. Now, why adjustment of change in working capital is important? So as we can see here again in step number 4 here, we can see that there is adjustment for change in working capital. Okay. Now, why it is important? So let us just try to understand this from this particular table here. Okay, so this is your previous year. Okay, towards right hand side, your previous year will be there. Okay, and towards the left hand side, your current account is present. Okay, so as we can see here that debtors in the previous year were 1,50,000, but in the current year it is only 1,32,000. Okay, so which means that debtors are being decreased by 18,000 rupees. Okay, so in the previous year you had the debtors of rupees 1,50,000, but in the current year the debtors are only 1,32,000, which means 18,000 money has been received from them. Okay, so this 18,000 is actually the inflow of cash from debtors. Okay, and similarly for creditors. Okay, uh, in previous year they were 75,000, and in the current year creditors they stood as 34,000. Okay, so 41,000 has been paid to them. Okay, so this 41,000 is your outflow of cash. So this is actually disturbing, or this is affecting the position of cash. Okay, hence it should be adjusted while calculating cash flow from operating activities, because both debtors and creditors, okay, the transactions related to debtors and creditors are operating activities. Okay, hence it should be adjusted. Okay, and after that we have to make the payment of tax, because tax is a part of an operating activity. Okay, because you are paying the tax just because you are involved in the business. Okay, if there is no business, then there will be no tax for that. Okay, now golden rule for adjustment of change in working capital. This is quite tricky one. Okay, in terms of current assets. Okay, for this current liabilities, it is very simple. If there is increase, okay, increase add or plus. Okay, increase means plus, decrease minus. Okay, for current liabilities. Okay, if any current liability is increasing, let us say this creditors or bills payables are increasing, then if they are increasing, then do plus or addition. Okay, if they are decreasing, then do subtraction. Okay, but for current assets it's quite the opposite. In fact, if the current assets they increase, then do subtraction. Okay, and if they decrease, then do addition here. Okay, as we can see here in this particular table here, this debtors they are actually decreasing, isn't it? Previous year they were 1,50,000, but in the current year they are only 1,32,000. So by 18,000 they are decreasing. So if they decrease, you do plus or addition. Okay, and here creditors they are decreasing by 41,000, isn't it? So if they decrease, do subtraction. Okay, now these are the things that you should remember. Okay, just go through this. You have to understand these points. Okay, and have a look at the book. Out there you will see the format of cash flow statement. Okay, and other things are also there to be discussed. Okay, which will be explained when we solve numerical questions. Okay, regarding this provision for tax. Okay, how to calculate the tax paid. Okay, what to do with the proposed dividend. Okay, because sometimes in question proposed dividend will be given for both the years, that is for past year and the current year. Okay, and how to treat interim dividend. So many things are there which will be discussed when solving numerical questions. Okay,